Welcome to the Market Fundamentals. In this module, we're going to look at the forces behind the scenes that affect the value of a currency. The fundamentals of a currency market are items such as interest rates, interest rate differentials, economic growth of a particular country or region, the sentiment regarding its stability, and often how it relates to the US dollar and other currencies. We call this the currency drivers, and let me tell you what they are. Currency driver number one, interest rates, which is often the key driver in valuation. Currency driver number two, economic growth and indicators, such as GDP. Currency driver number three, safety and sentiment, areas such as confidence, debt and solvency, liquidity, and of course the ratings from firms such as S&P, Fitch, and Moody's, and other areas such as currency personalities and performance. To help us cover market fundamentals, I'd like to welcome back our experts, Sean Hyman and Evaldo Albuquerque. Welcome, gentlemen. Can you share a little background on your currency trading history? Sean?
Sure. Billy, thank you for having me back. It's a great pleasure to be here to help our viewers take the next steps in trading the currency market. And in many ways, Forex trading is like playing a game, really. In this game, your edge will be having the fundamental understanding of the nature of the Forex market. In getting acquainted with Forex, most people start by looking at charts and price patterns. This is called technical analysis. But the study of what moves these charts is called fundamental analysis.
But Sean, there is a tendency to stereotype traders into two distinct schools, fundamental or technical. In fact, most smart traders favor a blended approach versus being a purist of either type.
Great point. Let me clarify. Fundamentalists need to keep an eye on signals derived from key sectors that impact currency prices such as GDP, employment, interest rates, and fundamentalists look at data relating to economic growth and inflation. On the other hand, technical traders focus on patterns that indicate trend breaks and those that provide indicators of strong support or resistance.
Let's start with the basics, if you don't mind. My first question, how do we forecast economic conditions?
Gross domestic product, or GDP, and employment reports can give you a fairly clear picture of a specific economy's health and the forces that work behind it.
But you still need a method to translate that into specific trade entry and exit points, don't you?
Yeah, the bridge between fundamental data and the specific trading strategy usually comes from a trader's model. These models use current and historical data to estimate future prices and translate them to specific trades.
So would you say this is the science of knowing how to trade?
Yes, forecasting models are both art and science. With so many different approaches, that traders can get overloaded. It can be tough to decide when you know enough to pull the trigger on a trade with confidence. Many traders switch to technical analysis at this point to test their hunches and to see when the patterns suggest an entry.
Okay, so what are the fundamental things that drive the market? Evaldo?
Well, the fundamentals include everything that makes a country and its currency work. From interest rates to central bank policy to natural disasters, the fundamentals are a dynamic mix of distinct plans, erratic behaviors, and unforeseen events. Not every development will move a country's currency. Try to start by identifying the most influential contributors to a country's or region's strength versus following every fundamental. There will be different fundamental factors for different regions. For example, the Australian dollar is affected by the interest rate of its central bank, but also by economic growth in China, because Australia is China's major supplier of natural resource. So if China slows down, the currency could lose value.
An interesting point. I know you're originally from Brazil, and even though Brazil is not one of the major currencies, what would be a fundamental factor that would affect their currency, the real?
You're right, it's not one of the 8 major currencies, but in my opinion, it's an important exotic currency to watch. Brazil's real has been appreciating for years based on the economic growth and commodity growth in the country.
What makes the real something to watch?
Last 8 years, the government has implemented a lot of policies to boost domestic consumption, reduce poverty, to be independent from the volatile oil market, and stimulate the economic growth. But there are other exotics that could be important to watch. Mexican peso, South Africa rand, Polish zloty, Czech koruna, Turkish lira, Hungarian forint. Those are only a few currencies that I like to follow.
Okay, I think I get it. So let's start from the top and let's talk about interest rates because that seems to be the number one point. Sean, what do you think about that?
Yeah, really, interest rates are the most important factor that affects prices, as interest rates are the modern tool that central banks use to put the throttle in their economies. A common way to think about interest rates is how much it's going to cost to borrow the money, such as for your mortgages, or how much you will earn on a bond or in the money market investments. Interest rate policy is a key driver of currency prices and typically a strategy for new currency traders. It also controls inflation, which affects currency value. Fundamentally, if a country raises its interest rates, its currency will strengthen because the higher interest rate attracts more foreign investors. For example, higher rates in the Eurozone may prompt U.S. investors to sell U.S. dollars and buy bonds in euros. Bentley, let me give you a quick example.
That'd be great.
For instance, let's say you have two banks across town. They're in the same town, and you've got one bank that has a savings account that will reap 4% on your interest. And across town, in the same town, you've got one bank, the other bank, that will reap 1% on its savings account interest. Now, you don't have to be a rocket scientist to see where the money flow is going to go. All things being equal, the money is going to run to the 4% savings account rather than the 1% savings account. And so this is a way that really an investor can look at this to see how rising yield attracts money to it, and the more buying that happens in that drives up the value of that country's currency.
Okay, so can I maybe elaborate a little bit on what you're saying is that maybe Australia has a higher interest rate than you might find in the United States, so therefore the money might flow to Australia to pick up on that higher rate than it would be to stay at home.
Yes, exactly.
Okay, so like your bank example across the two sides of town, across the world, we have those types of options. Okay, great. That makes a lot of sense. I think that clears it up for everybody. What is the role of inflation in all of this?
Inflation and the fear of it is a key factor in currency trading. It's really the elusive enemy of central banks around the world. Read any national paper on the financial condition of the country, and you'll find that a major initiative of any government is to contain inflation. Most central banks around the world monitor inflation and raise interest rates in an attempt to slow down the rise of inflation. So whenever inflation is feared to be on the rise in an economy, traders interpret this fear as raising the probability of interest rates that will increase, which will therefore support the buying of the currency.
We hear a lot about safe havens when currencies are going into the volatile territory, such as when a currency crashes. Sean, can you share with me a little more about that?
Sure. Historically, gold is a safe haven, a country-neutral investment, and an alternative to the world's other reserve currency, the U.S. dollar. Now, Billy, you shared with our students how gold was once the world's reserve currency. That no longer holds. It no longer holds that position, really. Gold is a safe hedge against a falling dollar. Typically, but not always, gold prices have an inverse relationship to the U.S. dollar. For example, if gold breaks an important price resistance level, you'd expect gold to continue to move higher, and you might expect the dollar to lose value. Therefore, you might sell dollars and buy gold or another currency that is basically mimics the price of gold, for example, as a proxy for higher gold prices. Rising gold prices help major gold-producing countries, those that are large exporters of gold. So the currencies of these countries tend to strengthen as gold prices rise. You might consider going long these currencies when gold is increasing in value. It's important to note that there are times when gold can go down at the same time the dollar goes down. It happens if there is a market sell-off.
Okay, so what about oil? Is that the same as gold as a safe haven? And Avaldo, what's your thoughts on oil?
Bentley, oil can be a good investment, but it's not a safe haven like gold. Oil price can be very volatile. As with gold, oil tends to go up when the US dollar weakens. This is primarily due to oil being priced in dollars. If it takes more dollars for other nations to buy oil, the price of oil tends to go up. But oil has other factors that affect its price, such as political unrest in countries in the Middle East, including terrorism, wars, or even government upheavals. Oil is also affected by natural disasters such as hurricanes, which, as we saw in the last decade, can shut down oil rigs for months, if not longer. Another thing to note is that currencies from oil-dependent countries can weaken as oil prices rise. Stocks can do the same. In the same way that the airline industry and other oil-dependent industries are hurt by rising oil prices, so are the currencies of oil-dependent countries. Examples of this include the US and Japan, both of which are massively dependent on oil. If you believe oil prices will continue to rise, you can consider buying currencies from commodity-based economies such as the Canadian dollar. But when these commodities are selling off, these same currencies will tend to weaken, and trading on their weaknesses can be a good strategy.
Okay. Let's talk about indicators. Give us a hint about what may happen in the future. Sean?
Economic indicators are snippets of financial and economic data published regularly by governmental agencies and the private sector. These statistics help market observers monitor the economy's pulse, so it's no surprise that they're followed closely by almost everyone in the financial markets. With so many people poised to react to the same information, economic indicators have tremendous potential to generate volume and move prices. It might seem like you need an advanced economics degree to interpret all of this accurately, but really, traders just need to keep a few simple guidelines in mind when making decisions based on this data.
So a good trader knows exactly when each of the indicators will be released, and you can find these calendars at several locations on the internet.
Yes, exactly.
Okay.
Watching the economic calendar not only helps you consider trades around these events, it helps explain other unanticipated price actions during these periods. Mm-hmm. You can find these kinds of information on websites such as you see on your screen right now.
Could you give us another example, if you don't mind?
Sure. Consider this scenario. It's Monday morning and the U.S. dollar has been in a tailspin for 3 weeks, with many traders are short the U.S. dollar in their positions. But on Friday, the U.S. employment data is coming out. They have a significant impact on the dollar, but you have no idea which way it'll go. The dollar could rise or fall significantly. But you don't need to understand every nuance of each data release, but you should try to grasp the key large-scale relationships between reports and what they measure in the economy. For example, you could show which indicators measure the economy's growth, such as GDP or gross domestic product, versus those that measure inflation, such as consumer price index or CPI, or employment strength, such as non-farm payrolls. Not all economic indicators will move markets, but the market often pays more attention to certain indicators under certain conditions, and that focus can change over time.
For example, if prices, inflation, are not a crucial issue for a given country, but its economic growth is problematic, traders may pay less attention to inflation data and focus on employment data or GDP reports. Often the data itself may not be as important as whether or not it falls within market expectations. If a given report differs widely and unexpectedly from what the economists and market pundits are anticipating, market volatility and potential trading opportunities may result.
Yeah, at the same time, be careful of acting too quickly when an indicator falls outside of expectations. Each new economic indicator release contains revisions to previous released data. So traders need to filter the data judiciously for their own purposes and make intelligent trading decisions.
For example?
Like for instance, you could have a non-farm payroll report, or what they call the NFP report, and let's say the expected number is 30,000 jobs to be created, but yet only 10,000 jobs are created. Well, it looks like it's a bad number because they missed the mark by 20,000.
Right.
But the last month's revision might have gotten revised from 40,000, up to 80,000. Well, that's another pop of 40,000 jobs created on a net basis. So really, it wasn't far off the mark like the initial headline might have said initially that you read.
Okay, so I seem to understand. In fact, some of the times the headlines could be a little misleading. So what you're saying is really you need to check those indicators yourself and understand where things will fall out.
Exactly.
Hopefully, this discussion has helped you realize that the importance of watching the economic indicators and knowing which of the data points are most likely to move markets and impact currency trades is pretty important stuff.
Yeah, just remember that no individual's knowledge can be complete all the time. You might have a great handle on economic data published in the U.S., but there are times when data published in Europe or Australia might have a surprising impact on the currency market. Doing your homework before trading any currency will help you stay on guard.
Well, it sounds like to me that maybe it's really important, since most investors are typically keep their U.S. dollars in America, that they need to start learning a little bit about world events and what's happening as you're trading with currencies. Let's talk a little more about economic indicators. These are currencies' vital signs. Am I correct with that?
Yeah, you can see the economic health of a given country and its currency through its economic indicators. But just like, a doctor monitoring a patient's vital signs, not all stats count equally. Here's a primer for the key economic indicators that often impact currency traders. Economic indicators divide into leading and lagging indicators. Leading indicators are economic factors that change before the economy starts to follow a particular trend. They're used to predict changes in the economy, whereas lagging indicators are economic factors that change after the economy has already begun to follow a particular trend, and they're used to confirm changes in the economy.
Okay, so let's become familiar with the major economic indicator, which is gross domestic product, or is known as GDP.
Yeah, GDP, for instance, is the sum of all goods and services produced either by domestic or foreign companies. GDP indicates the pace at which a country's economy is growing or shrinking, and is considered the broadest indicator of economic output and growth.
Okay.
Then there's industrial production, which is a measure of the change of production in the nation's factories, mines, and utilities, and it also measures the country's industrial capacity and how fully it will be used, or the capacity utilization. The manufacturing sector accounts for 1/4 of the major currencies' economies, so it's critical to watch watch the health of the factories and whether their capacity is being maximized.
Okay, so what does GDP have to do with a currency? How does it actually affect the price of a currency? Valdo, what's your thoughts on that?
Well, a country that has a higher GDP rate, in other words, a country that is growing faster than other countries,
yes,
will attract a lot of capital from investors. So that capital will boost the value of the currency. That's why, for example, you see currencies like the Brazilian real have appreciated a lot in the last few years, because a lot of investors are interested in investing in Brazil because it's higher growth rate.
Okay, and growth would probably mean a little more safer environment and things are happening, so I would assume that's why the currency has more value.
Well, in good times, yes. In good times, investors just look for the higher growth rate.
Okay,
in the economy.
And get a better return.
But all else equal, economy with a higher GDP rate will attract more capital. So the currency will tend to appreciate.
Excellent. Sean, do you have any thoughts on it? Or?
Yeah, you can also relate it to the stock world. Like, for instance, a lot of money will move into a stock like Google or Apple because they're in this high growth mode in the phase of their corporation, so it attracts a lot of capital, and the stock prices just go through the roof because of that high growth pace. On the other hand, you might have an IBM or a General Electric that are a little bit more mature companies and not grow quite as fast, and you won't see their stock price shoot up quite as quickly as these other two, because they're not attracting quite as quick of a surge of the capital all at once that's driving those stock prices up. So just like that, a fast GDP is, a fast-growing GDP is attracting a lot of capital and really causing that currency to shoot up and become a leader ahead of other currencies that are, that have their economies growing at a slower pace.
Well, that's great, because that's how I judge my stocks, is exactly what you just shared with me, how well a company is doing and what their potential for growth is. And so GDP is what Evaldo said, is the country's response to that same kind of thing. That's really good information, and that's something you should mark down as an important indicator to keep track of. So let's talk about PMI, the Purchasing Managers Index. Sean, I know that's one of your favorites.
Sure. Yeah, the Purchasing Managers Index, or PMI, is a monthly composite index of national manufacturing conditions. The index includes data on new orders, production, supplier delivery times, backlogs, inventories, prices, and employment, and import and export orders even. It's divided into manufacturing and non-manufacturing sub-indices. It's like a gauge of the corporate world and basically what they're feeling at the time. It's a sentiment gauge of what the heads of the companies believe that the global markets are going to do in the future, so that they know what to buy. And then the Producer Price Index, which is another indicator, or what's called PPI, measures the average daily changes in selling prices received by domestic producers in the manufacturing, mining, agricultural, and electric utility industries, and it's a good gauge of inflation coming in the future. But honestly, CPI is really the most important for currency traders to know.
And that's the Consumer Price Index, one we hear the most about.
Right, that's correct. The Consumer Price Index measures the average price level paid by consumers for a fixed basket of goods and services. It reports price changes in over 200 categories. The CPI also includes various user fees and taxes directly associated with the prices of specific goods and services.
So why is that an important thing?
Well, CPI is basically inflation embodied. You're tracking inflation. So if inflation rises, a central bank will raise interest rates to slow inflation. All things being equal, a central bank raising rates will be bullish for a country's currency. It's because traders want that currency with a higher yield, so they will start buying as soon as those central banks start hiking rates, and that pushes up the country's currency price.
Also, most central banks have CPI written into their mandate. So if the CPI reaches a certain percentage, they will act. For example, China, as we speak, has a target CPI of 3%. So if inflation goes above 3%, they will start thinking about raising interest rate to control inflation, and that is usually good for the currency.
Yeah, and another indicator is durable goods orders, which measures new orders placed with domestic manufacturers for immediate and future delivery of factory hard goods.
And a durable good is a product that lasts, over about 3 years, such as maybe a dishwasher, or a car, or even an airplane. I know sometimes companies and consumers put off purchases of durable goods during tough economic times. What does that have?
Yeah, true. This is a figure that is a useful measure of certain kinds of customer demand.
I know retail sales is another indicator, and then housing starts is one also.
Yeah, these round out the list of indicators I want to present. Retail sales is the timeliest indicator of broad consumer spending patterns. Retail sales includes durable and non-durable merchandise sold, as well as services and excise taxes incidental to the sale of the merchandise. It does not include sales taxes collected directly from the consumer. Housing starts measure the number of residential units on which construction has begun each month. Housing is usually one of the first sectors to indicate a potential slowdown or surge in economic activity. Historically, the market looks at housing data to anticipate in which direction interest rates are likely to go.
Okay, I hear a lot about housing starts. It's either up or it's down. And how does that actually affect the currencies?
Yes, actually, the latter half of the past decade was a nightmare, and it will probably take a decade to change it a lot. Housing is still, though, an important indicator because people feel good about the future and they're apt to buy a home. However, if they feel that basically like the future is more uncertain, and even more importantly, their job is uncertain, then they will refrain from buying a home.
Makes sense.
Also, after homes are purchased, there are a lot of other purchases that stem from that, such as furniture, appliances, remodeling, etc. So if people aren't buying as many homes, then you can bet it will weigh up on these other segments of the economy as well. Now, another facet about housing is that it has that if the value of their home is rising, people feel like they're better off and they're more apt to spend more in the retail marketplace.
Okay.
So if the value of their home is going down, then they feel poorer and they are more apt to tighten up their spending, quite a bit actually, which could hurt the retail marketplace. But as housing booms, it ripples into many other areas of the economy and aids the overall economy and its growth. And it's good for the country's currency. If there is a dive in home buying, then of course that can be bad for a country's currency.
Okay, makes sense. And I'm sure not all reactions are based on the numbers, at least not always. When I'm deciding what to do in a given situation, often sentiment or emotion and confidence are going to play a big role.
Yeah, it's true. Currencies are affected by more than just the economic conditions of a region or country, really. Sentiment or emotion about that market, a situation or an event, just as you said, affects currency values. It creates a sense of confidence or despair. If confidence is high, then the market will interpret that as positive for the currency, because greater confidence indicates expansion and growth for the economy.
And I'm sure the reverse is true as well. If sentiment and confidence are low, the economy is probably going to go through a downturn.
Also, one region or country in the world could have an effect on another based on events.
Okay.
For example, there are 4 exotic currencies that are affected by the euro's performance. When the massive sovereign debt crisis hit the eurozone in 2010, the euro depreciated against the dollar, and the Hungarian forint, Polish zloty, Czech koruna, and Turkish lira did the same. That happened because these little European economies are all tied to the euro's performance, so they all fell with the euro.
Yeah, in other words, when one currency sneezes, another one catches a cold.
Right, being able to recognize these kinds of cause and effect relationships can be a huge benefit for the trader. Sources such as Consumer Report can also provide a leading indicator to the currency trader. It's interesting to note that every country has its own version of investor and business confidence, and these in effect form a leading indicator about a currency direction.
Actually, I'd like to add my 2 cents in here as well in this conversation. Unique fundamental circumstances and the transition from one trading center to the next can create distinct currency personality traits that traders can use to their advantage. The vast majority of trading volume in the global currency market pairs are in the U.S. dollar with other major currencies.
So, which currency pair should you trade? The technical trader will look to trade the currency pair that shows a high probability pattern. But it is important to note that different currency pairs have distinct attributes and behaviors that can be characterized as personality traits, as Sean mentioned. And these traits have important implications for trade timing, entry and exit levels, and other aspects of trading. Traders are likely to experience better results if they are aware of the traits exhibited by different currency pairs and the forces behind such traits. There are a number of factors that influence the trading personalities of major currency pairs, and they all stem from real life, and in most cases, these factors are quantifiable. The primary element that defines a currency pair's trading personality is its liquidity. Although the global currency market is the largest and most liquid of all financial markets, that liquidity is not evenly distributed across all currency pairs.
Yeah, also, liquidity can vary significantly throughout the trading day, depending on which financial centers are currently active. Overall liquidity fluctuates as the trading day progresses, and at no time is this more evident than from the early hours at the opening of the week's trading, when only a few trading centers, namely Wellington, New Zealand, and Sydney, Australia, for instance, are active and liquidity is at a low point. This is why many experienced traders will avoid the first few hours of trading on Sunday, and most of them won't even come back into the market until the London opening on Monday morning. That's when the huge pools of liquidity come back, because that's where the large institutional traders are back at their trading desks. This same phenomenon actually happens on Fridays after about 12 noon Eastern Standard Time, when many of the London and U.S. institutional traders head out for the weekend. The volume drops off quite a bit, and trading can become quite a bit more erratic after that time.
Excellent points. To take that one step further, I would recommend traders to not trade over the weekend because the market volume is so light and the market is extremely volatile.
Guys, this is great, but I need to get us back a little bit on track. With a better picture of market liquidity, let's examine some of the characteristics of the most active major currency pairs, which are called the major currencies, and how they might affect trading decisions. So first, let's talk about the euro-US dollar, if it's all right.
Yeah, their premier status reflects the fact that the U.S. and the Eurozone are the world's 2 largest economic zones. The euro is one of the 3 legs, really, of the world's major currency blocks: euro, dollar, and the Japanese yen, and thus reflects major shifts in global asset allocations. Of course, euro-dollar will respond to Europe-specific developments such as interest rate changes, economic data, and major financial upsets like the sovereign debt crisis, for instance.
Sure.
But generally, it will be the dollar side of the equation that drives the currency pair. As a result, traders need to be aware of the dominant themes driving the market and understand whether it is the U.S. or the European-based story behind a move.
Okay, and so how about U.S. and Japan?
Yeah, the Japanese yen, or JPY, has been the 3rd leg of the major currency trading block in this triangle. The Japanese yen has also been mired in deflation for so long that it kept rates at near zero. And as such, it's become another safe haven, low yielder that traders rush for when there's uncertainty in the markets. Therefore, it's a major currency, but it's very unique as far as these currencies go.
We know about euro and we understand the Japanese yen. What about the British pound versus the dollar?
Yeah, the British currency is traditionally among the most volatile and erratic currencies in the market because of its lower liquidity, basically. Prior to the introduction of the euro in 1999, only the Commonwealth currencies, which are the pound, the Aussie, and the New Zealand, had values denominated in U.S. dollars. Historically, this meant that movements in the pound were among the most risky and expensive, which restrained market interest and liquidity. And because of this lower liquidity and higher volatility, traders like the pound because of its potential to move farther basically in a single day. Bigger moves mean bigger profits for traders, and if you're on the right side of that trade especially.
Yeah, I guess if you're on the wrong side, it could be the opposite as well. What about other currencies such as the Swiss franc?
Well, the Swiss franc, or Swissy, holds a place among the majors because of Switzerland's unique stature in the global financial marketplace. It's estimated that about 1/3 of the world's private assets are domiciled in Switzerland. Given its historical neutrality and legendary privacy laws, Switzerland's currency is frequently viewed as a safe haven alternative to the US dollar in times of geopolitical uncertainty. The Swiss National Bank is one of the more active central banks when it comes to influencing its currency, but this mostly applies to the franc's level relative to the euro, since the vast majority of Swiss trade is with the Eurozone.
Okay, so now we understand all the different currencies. Let's discuss the personality and performance of the U.S. dollar.
Sure. Gaining a fundamental understanding of the U.S. dollar and the U.S. economy is a critical part of becoming prepared for trading in the currency market. Mm-hmm. Much of the world's trade is denominated in U.S. dollars, and it's true that we're in a period where there's a huge amount of growth in Asia. This growth is most likely means the preeminence in the U.S. economy will basically diminish over time in the coming years. And however, though, the U.S. economy is still remains the critical pivotal point of the world economy for now, and we will need to pay close attention to the U.S. economic events.
Okay.
This is true in particular when trading currency pairs involves the U.S. dollar, which will involve making judgment calls about the direction of the dollar and with regards to other pairs. Before you enter the market, you have to ask yourself, are you going to be bearish or bullish on the dollar? As you go through the technical analysis module, you will learn to be able to look at the charts and indexes that will help you make this decision. If you were to look at history over the past decade or so, you would notice that the trend of the dollar is declining. Now, although it has had some rallies, there's been basically a continual downtrend. And one of the fundamental variables affecting sentiment in the U.S. dollar is the fact that as a nation, the U.S. has an enormous foreign debt, and it continues to grow. And as that debt grows, foreign countries have more incentive to diversify their reserves away from the U.S. dollar and into other currencies. So rumors of such diversification really lead to selling of U.S. dollars by those who want to risk holding, those who do not want to risk holding dollars. And this, of course, has the effect of weakening the support for the U.S. dollar. Also, the U.S. dollar index is a good way to track global sentiment on the dollar, and the global currency trader basically should scan this chart daily. So look for the U.S. dollar index, probing support, resistance, and other key technical levels. This is where fundamentals and technical analysis really come together.
Okay, great. So as we did in the first module, we've developed a few exercises that's going to help you remember what you learned in this module, as well as help you learn to do the research. Take the time now, before you move on to the next module, and do the exercises in your companion workbook. Remember, this module covered the fundamentals of learning the Forex market. You can go back and review any portion of this program at your leisure by choosing the module that you need. There are a couple things I'd like to add. I wouldn't advise that you go out now and make your first trade. You need to get into shape from a fundamentals point of view, go through some of our recommended exercises. And remember also what I said at the beginning, you need a balance of fundamentals and technical analysis, and that's our next module. So first, let me summarize what we covered in this fundamental module, and then we'll move on to the next one. Forecasting economic conditions, understanding gross domestic product, or GDP, forecasts, and employment reports. They can all give you a fairly clear picture of a specific economy's health. The fundamental drivers are everything that makes a country and its currency work, from interest rates to central bank policy to national disasters, behaviors, and unforeseen events. Economic indicators are snippets of financial and economic data published regularly by governmental agencies and the private sector. These statistics help market observers monitor the economy's basic pulse. Sentiment, confidence, and safety are feelings or emotions that cause a view or attitude about the situation or event. If confidence is high, the market will interpret that as a positive for the currency because greater confidence indicates expansion and growth for the economy. Remember that the vast majority of trading volume equates to the US dollar and that the personality and performance of a different currency pairs have distinct attributes and behaviors that can be characterized as their own personality traits. These traits have important implications for trade, timing, and entry and exit levels. Sean, Evaldo, it has been a great pleasure working with both of you. I think you've done an amazing job of bringing out the information about fundamentals to our students. I thank you for being here with me, and I look forward to working with you in other modules. Please make sure you do the exercise on conducting your own fundamental analysis. We hope that you've enjoyed this module, and as in the first major step you must take, this completes the fundamentals module. Thank you, and we wish you super success. Bye now.